I never thought that I'd ever say this, but I strongly believe now that fundamental analysis in investing is completely dead. 10 years ago, nobody would ever have said this. 10 years ago, it was all the rage about Warren Buffett, how he's buying undervalued companies, how he's buying companies with a moat around it, right? Coca-Cola that has a brand that cannot really be disrupted, that's always going to be around. That was the general sentiment in investing, but this has 100% shifted in those last 10 years. What happened? First of all, academics happened. Academics found out that most stocks underperform most of the time. Academics found out that most retail investors underperform the index most of the time. And academics had been incredibly vocal about those findings. So in the end, the word spread. And in the end, people decided to buy low-cost index ETFs. If it's that unlikely to beat the index, whether by yourself or whether by buying an actively managed fund or whether by buying a hedge fund, right? When it's that unlikely to beat the index, then simply just buy the index and buy it for as little cost as possible. So people just allocated to the ETFs. People didn't do fundamental analysis anymore on individual stocks because it's a losing game anyways. So that's the first thing that happened. The second thing that happened is, of course, crypto. Right? Not just Bitcoin, but crypto in general. Suddenly, we've got meme coins like Dogecoin that trade in the billions and billions of dollars that have literally been created as a joke. And they are still a joke. And still they've got billions of dollars. Then we've got GameStop that got shorted a lot, that then turned into a meme stock. Right? We got AMC. So we've got all kinds of divergences from the internal value, from the intrinsic value that actually move the prices anyways. Those kinds of developments are completely new in the last 10 years. Some people have been visionaries to a degree, right? Some people already did quant trading in the past, did statistical analysis, they tried to find out where's demand and supply developing. They didn't necessarily think about the fundamentals that much. They simply just traded based on statistics, based on numbers, not necessarily based on the story, what kind of moat the company might have around this, right? How much they could defend their business model. But let's still make the case for value investing. Let's say you're still looking for undervalued stocks. And let's say we don't take the very large stocks because those are already covered by the big banks, right? They've got analysts from Harvard, and I don't know for where, that always analyze all kinds of things, that listen to the earnings calls, etc. They probably have a pretty good pulse on those larger stocks. So let's say you want to find an undervalued stock that is a very small cap, where it's not really worth it for the banks to hire an analyst to look at this, right? You want to find the market inefficiencies, and the market inefficiencies are normally in the smaller things, right? In the very segregated, intangible things, small markets, that's what you're looking at. So let's say you do your analysis and you find a stock that has 20% dividend yield, and that actually was able to turn their business around, right? Maybe the price first went down because whatever kind of macro impact there was, maybe there was some kind of regulation. Let's say we are talking about a hotel chain, a very, very small hotel chain that was still able to IPO. And let's say that hotel chain was hit by COVID. And because of COVID, the price of that micro stock also went down. And now the dividend yield is 20% on that hotel chain. Why would you buy? Would you buy for those 20%? Are you actually content with buying the stock, getting your 20% dividend yield, and making your investment based on that thesis? Most people that are actively trading, most people that put in a lot of time into investing, they want the returns as quickly as possible. So they don't want to necessarily follow that hotel chain for the next 5 to 10 years and just collect the 20% dividend yield. Most people in that category, they want to buy this for undervalued, and they hope that the market at some point in time will catch up. As in, the market will realize 20% dividend yield is way too high for this hotel chain. The price should be at least double. So that's why undervalued stocks are being bought. They're bought because you're hoping the price will double, because the intrinsic value is way, way higher than the current price that it's been traded at. So you're hoping for the market to have a realization. You're hoping for the demand for the stock to go up because of fundamental reasons. So actually what you're doing is you're also making somewhat of a momentum trade, somewhat of an attention trade. The price is simply just the result of demand versus supply. And if there is a lot of demand, then the price goes up. And that demand can come from several sources. And what you are speculating on with buying undervalued stocks is that there is still enough demand hovering around the market, enough investors that are just like you that will realize that this hotel chain is extra cheap. And those kind of people should be buying as well, pushing up the price until the price hits the fair value. That's actually what you're betting on. You're not betting on the 20% dividend yield, hoping that the company will survive. You're betting on the intrinsic value to realize itself in the market through additional demand once people realize. So how does fundamental analysis help here? Fundamental analysis can help to make a case, right? If you are convincing others, let's say you have a YouTube channel and you're convincing others to say, this is a great stock because I ran the numbers, because this is a very solid business with high dividend yield, why don't you buy it together with me? What you're actually doing is, because of the fundamental analysis you've done, you've made a convincing argument for other like-minded people to buy. The question though is, how many like-minded people are there that are digging into the nitty-gritty details of a stock and that are interested in your number crunching?
Here are the videos that work on YouTube. XRP will be $12,000 guaranteed, or an AI explosion, top 3 cryptos to buy in November. A lot of pushing of greed, that's what gets the clicks. What doesn't get the click is a tutorial on how to make backtests, on how to build those sheets that in the end figure out what historically worked well in the past. The backtest that I often show here on this channel. I still very much enjoy producing this kind of content though. I also share these kinds of sheets, but I don't do it on YouTube. You also get direct access to me. Feel free to check it out. It's thebitcoinstrategy.com.
There are probably more people that are stupid money. Right? More people that simply just want to hear a story. People that don't want to necessarily crunch through your Excel sheet. The masses are not necessarily that sophisticated. So if you want to make a story for demand, right? If you want the price to go up, you don't have to go that sophisticated. You don't have to determine the intrinsic value. You simply just have to pump and dump, which by the way, I never do on this channel, right? Whenever I talk about any cryptocurrency on this channel, I mainly talk about crypto. We're not talking about stocks. But whenever I make a video about any asset on this channel, I always publish the video here first before I buy. When I buy a cryptocurrency, it's always several hours after publishing a video. Just to make this clear, I know a lot of other influencers are different. I'm very serious about the conflict of interest here. But it's simply to make this argument here, right? Fundamental analysis does not necessarily have real value in increasing the probability, in turning the odds in your favor, for creating attention for the market to realize that this is a cheap asset. So really, investments are driven by attention nowadays. They are not driven by fundamentals anymore. There's simply too few people that do fundamental analysis that could join you. People that invest in stocks simply passively allocate via ETFs, rightfully so for most people. People that want to get the quick gain, they simply just ride the attention wave. People aren't really interested in your Excel sheet showing people how this particular company might be a bit cheaper than its competitors. So what can we take from this? I personally take from this that I'm not really looking at the balance sheets anymore. I'm not looking at the P&Ls anymore, because this is not where we can get the market edge. I'm looking at attention analysis. I'm looking at how many people are talking about this on Twitter. How is that attention relating to the price? Is there a lot of people talking about it and the price hasn't yet increased as much? I'm looking at the attention on YouTube. I have an unfair advantage here because I see my YouTube statistics. So when I publish videos about altcoins, let's say I publish 5 different videos on 5 altcoins, and I look at how many views do those different videos get, just based on the views, I can already tell how much potential demand there is for an altcoin. right? So looking at social metrics is super nice. Looking at the number of Twitter followers, looking at the number of searches, looking at the number of YouTube views, whatever it is, it's about the attention. It's about, is there still attention growing? Are there still new people coming into the asset? And that's why crypto is so nice, because crypto also has on-chain analytics, right? So when the price goes up, we can see, is this because a few whales are buying, or is this because a lot of new retail investors are buying in? We can actually find out the fundamental reason. We can dissect the attention in a bit more detail and can find out why is the price going up or down. And based on that, we can then make a prediction, right? If there's still enough retail people buying in, and maybe if that's even accelerating more and more, then it's potentially time to jump on that positive momentum. If it's only a few large whales that pushed up the price, then we might see another pump and dump. So this is how we can differentiate the things, right? So I'm not necessarily interested anymore in the fundamental value of that DeFi protocol, how much yield it could generate. I'm just interested in attention. I'm just interested in buys and sells, because buys and sells make the price. And as long as the number of buyers is increasing faster and faster, I want to be in this. And whenever the growth stops, I want to be out. This is fundamentally how I think the investment landscape has shifted. It's now much more player versus player. There's now much less growth in any assets. We are in mature markets. A lot of the returns we see in stocks are now simply just monetary printing. It's not necessarily GDP growth anymore. I made other videos on this, right? Feel free to, for example, divide the US GDP by the US money supply, and you will have a bit of an awakening. We haven't seen any real growth. If we divide this by the money supply for several decades, that's why people are struggling. That's why people don't have families, etc. So we are not anymore in an economy where you can simply just allocate and forget and hope to get ahead in life. We are now in an economy where you have to analyze the data better than the rest, and investing and trading isn't necessarily that passive anymore, at least if you want to make real purchasing power gains. If you want to make gains in purchasing power, you have to be better than the average, and you have to play the attention game, not just the fundamental analysis game. A very, very different landscape to 10 years ago only. And this then also reflects, of course, in returns of people that are focused on fundamental analysis, right? When you now look at Warren Buffett's returns relative to the S&P 500, so divide the Berkshire Hathaway price by the S&P 500 price, you don't necessarily see that much outperformance anymore over the last 20 years. And it's simply because now it's a much more attention-driven market compared to the early, way less efficient days. If it's your first time here, feel free to subscribe. Feel free to also give this a like. It will help the channel grow. Last but not least, there's also a Telegram. Feel free to check that out. Looking very much forward to chatting with you in Telegram. The link is down below. Cheers.